Hello, my name is Jarek Wan, and this presentation provides the executive summary and strategic analysis for Nike Inc. The purpose of this benchmark is to synthesize the full body of strategic work completed throughout the course and recommend a practical plan to improve Nike's competitive advantage. My central argument is that Nike does not need a complete reinvention. Instead, it needs a disciplined, innovation-led correction focused on rebuilding wholesale, omni-channel strength, restoring premium product leadership, localizing more effectively in Greater China, and improving supply chain resilience. So today I'll be going over an executive summary, baseline performance, external and internal diagnosis, competitive position, portfolio view, why wholesale omnichannel rebuild wins, leadership skills and decisions required, research support for the recommendation, financial feasibility, 3-year implementation roadmap, key risks and mitigations, stakeholders, final recommendations, and my references. The lead strategy is wholesale omni-channel rebuilding and brand premium restoration. That is the right starting point because Nike's most immediate performance problem is weak marketplace execution. Fiscal 2025 results showed declining revenue, weaker margin, and falling Nike direct sales, which signaled that Nike's previous channel strategy had become unbalanced. The broader strategic tools support a corrective growth strategy, not a defensive retreat. The company's EFE and IFE scores show that Nike remains strong but under-executing, and Q2 fiscal 2026 wholesale growth gives early evidence that channel repair is already moving in the right direction. Financially, the plan is feasible with a 40% equity and 60% debt mix because the EPS differences across financing options are minimal. Nike's revenue fell 10% from about $51.4 billion in fiscal 2024 to $46.3 billion in fiscal 2025. Gross margin fell by 190 basis points. Nike Direct fell 13%, Greater China fell 13%, and net income dropped 44%. These declines show that recent performance weakness is not isolated to one metric. However, the most important interpretation is that this is not a brand collapse story. Nike still has broad relevance, but it drifted in channel balance, pricing discipline, product heat, and regional execution. The 8% wholesale growth in Q2 fiscal 2026 suggests that the company has already started correcting one of its biggest mistakes. Externally, Nike still operates in an attractive industry. The EFE score of 2.72 suggests that the company is responding only moderately well to that environment. Major opportunities include women's activewear growth, omnichannel retail expansion, China recovery potential, and broader activewear demand. The main threats are tariffs, Vietnam concentration, Chinese competition, and premium running challengers. Internally, Nike's IFE score of 2.64 confirms that the company remains above average in strategic capability. Its strengths include brand equity, innovation, North American profitability, scale, and liquidity. Its weaknesses include direct-to-consumer over-rotation, Greater China underperformance, Converse drag, and margin compression. Taken together, these results show that Nike is still strong, but its strategy needs correction so that those strengths produce better marketplace outcomes. The competitive profile matrix shows that Nike still leads overall with a score of 3.33, ahead of Adidas at 2.74 and Lululemon at 2.44. That matters because it confirms that Nike has not lost overall competitive leadership. At the same time, the score gap is not large enough to justify complacency. Adidas is stronger in wholesale balance, and Lululemon has sharper positioning in women's and direct consumer engagement. In addition, premium running brands such as On and Hoka are taking focus share in categories where Nike should be stronger. So the conclusion here is that aggregate leadership is real, but it does not eliminate the need for correction in specific channels, categories, and regions. North America, EMEA, and APLA are the company's cash-generating core and should finance the turnaround. The main implication is that Nike should not spread resources evenly across the portfolio. It should defend the strongest businesses, selectively rebuild the most important weak business, which is Greater China, and manage Converse with tighter performance expectations. Supply diversification is still necessary, but it is a supporting initiative rather than the first move, because it addresses structural risk more than immediate demand weakness. Execution of the lead strategy means rebuilding partner-specific assortments, tightening launch discipline, using digital membership data to support wholesale allocation, localizing China offers, and diversifying supply gradually rather than abruptly. Nike's leaders need 5 core capabilities: cross-functional integration, digital literacy, innovation discipline, marketplace accountability, and stakeholder communication. Nike's proxy shows that the company has experienced leadership depth. The real requirement is not simply new talent, but stronger system integration under one operating logic. The strategy is grounded in research showing that omnichannel and digital transformation efforts are most effective when supported by strong internal coordination, innovation investment, and aligned processes. It also highlights that successful implementation depends on effective leadership, clear stakeholder communication, and integrated change management. The strategy requires about $2 billion in capital. The recommended financing mix is 40% equity and 60% debt, which means approximately $1.2 billion in new debt and about 14.5 million new shares. This structure is preferred because it offers the best balance of flexibility and risk. Under the realistic EBIT scenario, EPS is about 1.92 under both the all-stock option and the 40-60 mix, compared with about 1.91 under the all-debt option. Since those differences are trivial, Nike should choose the capital structure that supports action while keeping leverage discipline. Implementation should happen in 3 stages. Year 1 is about repair, recover shelf space, tighten assortments, improve launch discipline, and stabilize key wholesale relationships. Year 2 is about scaling selective growth, expand women's growth initiatives, localize Greater China more effectively, accelerate running innovation, and use digital data to improve allocation. Year 3 is about strengthening the system, improve full price mix, diversify sourcing, optimize the portfolio, and lock in better margin quality. This sequencing matters because Nike's turnaround will succeed only if the company fixes the immediate commercial issues first, then scales growth, and only then pushes harder on structural resilience and optimization. Wholesale recovery could weaken margin equality if Nike prioritizes volume over full price discipline. That risk should be mitigated through sell-through tracking, full price mix targets, and partner scorecards. Second, supply diversification could create operational disruption if the company moves too fast, so the migration should be gradual and focus first on the most exposed categories. Third, Greater China may remain soft longer than expected, which is why localization must go beyond generic global messaging. Fourth, Converse may continue to drag results, so Nike should preserve a licensing heavy or divestiture option if recovery stalls. The theme here is that growth must be paired with controls. This strategy is also strong from a stakeholder perspective. For customers, it improves product newness, access, and the connection between digital and physical experiences. For employees, it creates clearer priorities and stronger accountability across functions. For retail partners, it offers better traffic support, stronger storytelling, and healthier sell-through. For shareholders, it creates a more credible path to margin recovery, capital discipline, and durable growth. The key point is that Nike does not need to choose between growth and control or between customers and investors. A disciplined turnaround can improve outcomes across all stakeholder groups if it is communicated and executed consistently. My final recommendation is that Nike adopt a 3-year turnaround built on wholesale omni-channel rebuilding, premium performance innovation, women's growth, Greater China localization, and selective supply chain diversification. The company should lead with the strategy that fixes its most immediate performance problem, which is marketplace execution. It should support that repair with stronger product innovation and localized growth moves, and it should fund the plan with a balanced 40% equity and 60% debt structure because financing should enable action, not delay it. Supply diversification remains essential, but it should support the turnaround rather than distract from restoring demand quality and channel balance. Nike's path forward is correction with discipline, not reinvention with focus. Here are my references.